Hello everyone, welcome to Lecture 9 on ACCA P7 Advanced Audit and Assurance. This lecture was on group audits. Okay, so groups first of all. Well, there's specific features to groups in particular. You're going to have those consolidation adjustments for the consolidated accounts. There are specific standards you have to comply with. There will be complex planning because there will be multiple auditors. You will be the principal auditor, and there will be other auditors which will be responsible for auditing the other components of the group. Okay, so how to decide whether you are the principal auditor? Well, this is under ISA 600, Special Considerations in the Audit of Group Financial Statements. We will assess the materiality of the component that you audit. You'll check the degree of knowledge you have of the components. You'll make a risk assessment, the risk of material misstatement that is, in the components. You'll see if you have to carry out additional procedures in the components. If you have significant participation in those additional procedures, it may indicate that you are the principal, and then you'll check, do you have a relationship with the other auditors. The objectives of the principal auditor then, well, he wants to gather sufficient appropriate evidence to form an opinion. He'll plan his own component, i.e. their element of the audit, and also the consolidated financial statements audit. Okay, so they will plan their own element and the consolidated financial statement audit. Okay, so auditing groups. Well, first of all, the other auditors. The principal themselves will rely on the work of other auditors because they obviously won't be able to go and do all the other audit work in the different components of the business. So they will consider the competence of the other auditors, their qualifications, any significant findings they make. And what they'll have to do is undertake procedures to satisfy themselves that all of these things are present, that the other auditors are competent, they are significantly qualified, and the findings that they have made are appropriate. So on to planning then. The principal auditor, well, the first thing they'll do is they will identify the group structure. They'll see if there have been any changes in it. They'll identify the materiality levels, and that will be both at the group level and at the level of the component. And they will identify any risks. The second thing they will do, they'll instruct the other auditors. They'll tell them about the group accounting policies. They'll request component management letters. They'll send out pro forma accounts, and they'll send out questionnaires to get the details of the other auditors and how they are going to carry out the audit. They'll also set out a timetable, first of all for agreeing the intercompany balances and intercompany accounts, secondly for when the fieldwork will be done, the submission of the pro forma accounts, the post-balance sheets events review, when are you going to undertake that, the group tax review, the timetable for that, and eventually the timetable for finalisation. At the review stage, well, they will have to review the work of the others and then decide if they have to undertake any further work. They'll review the other auditor's strategy, they'll perform risk assessments at a component level, they'll assess the business risks and discuss them with the component managers, and they'll check for any potential errors. If they find them, they'll discuss this with the other auditors. At the end of this, they will attend all the component group closing meetings to check that the sign-off goes smoothly. If there are any more tests required, they may have to attend some of the group premises and undertake that testing. So, at an accounts level then, what difference is there in auditing groups? Well, there's going to be the consolidation. The pro forma of the transferred accounts has to be done correctly. The classification of the component has to be correct. Third-party disclosures have to be made correctly. And then we have all the consolidation adjustments. So you'll want to check that the fair value adjustments were done correctly, that the goodwill calculation is correct, that the non-controlling interest calculation is correct, and that any intercompany trading or balances have been correctly adjusted for. And lastly, if you have foreign companies and foreign exchange transactions, you'll have to make sure that the translations are done correctly. This brings us on to another complex area, which is the area of tax. Remember that each part of the group may have differing tax positions. Some may be making profits, some losses. what we have to do is view the tax position as a whole. Remember that under consolidation there may be some tax consequences, and therefore we need to recognise these in deferred tax. But again, don't distort the tax position of the group as a whole. Related parties, remember related party transactions must be disclosed. Make sure that they've been correctly identified, and that the group, for the different groups, remember that the intergroup transactions are eliminated. If you're just showing the parent, well, there's no need to disclose the intergroup transactions so long as the parent accounts are presented with the consolidated accounts. So if you present the parent accounts with the consolidated accounts, there's no need for disclosure of the intergroup transactions. So other matters when it comes to group accounts: letters of support. A letter of support is when a subsidiary perhaps is not a going concern. They will get a letter from the parent saying that they intend to support the subsidiary financially. You can accept this as evidence, but you must consider the ability of the parent to help and whether the resources are available to give that help. A modified report in a group. Well, if it's immaterial at a group level, we can simply ignore the modification. If it is material to the group, well then we have to carry that modification through to the group audit report. If there's a disclaimer in the subsidiary accounts, you might have an except for paragraph in the group audit report. On to a joint audit then. A joint audit is different from a group audit. A group audit, you have a principal auditor and other auditors underneath. However, a joint audit is where two firms work together and issue a joint opinion. So they both jointly do the audit and are jointly liable for the opinion. The pros and cons of this: on the upside, you'll have better knowledge because the two firms will be able to work together. You'll have more resources again because you've got two firms, and that should lead to a better efficiency on the audit. On the other hand, you may get clashes between the two firms, and it may cost more because you have to pay both firms' fees. The Clarity Project then gives us a bit more guidance on group audits. ISA 600 now under the Clarity Project says that when you're accepting the audit, you have to check whether you are going to be able to gather sufficient appropriate evidence, i.e. the evidence that would be reasonably expected, both for the consolidation and for the financial information available. The engagement team under ISA 600 must now set the overall strategy. The partner will then review this. They have to understand the group, the components, the environment, the consolidation. All of these things must be understood by the engagement team. The partner then assesses the competence of the other auditors and checks that the ethical guidelines have been adhered to. Materiality then, again, it's set by the engagement team, and this is both at the group level and component level. We will use component materiality at a group level rather than group materiality under two circumstances: if the component is of financial significance, or if the component is risky, and that risk assessment is undertaken by the engagement team. The engagement team will also set the trivial misstatement level, i.e. a level at which misstatements are held to be trivial. The Clarity Project also states that the group auditors must communicate with the other auditors in writing the work to be performed and the use to be made of it, the form and content of communications between the parties. They request the cooperation of the other auditors. They'll check the relevant ethical requirements. The materiality and triviality levels will be communicated, the risks to the firm, and the list of related parties. All of these will be written to the other auditors. And that was our lecture on group audits.